Imagine a time when a single phone call could calm a financial panic, when the fate of entire markets hung on the words of one man. In the early 20th century, the world of finance was a place of uncertainty and drama, where fortunes could be made or lost in a matter of hours. The stock exchange floor was a whirlwind of activity, and the slightest rumor could send shockwaves through the economy. In those days, trust and reputation were as valuable as gold, and the right voice on the line could mean the difference between chaos and stability. It was an era when one man's word could reshape entire industries, when a single decision in a smoke-filled boardroom could alter the course of history. The titans of finance were not just bankers, they were kingmakers, visionaries, and sometimes saviors in times of crisis. Their influence extended far beyond Wall Street, reaching into the very heart of American society and industry. That was the era of J.P. Morgan and the bank he built, a titan that became synonymous with American finance. J.P. Morgan himself was a figure of almost mythical stature, a man whose presence could steady markets and whose vision helped shape the nation's economic destiny. His bank was more than just a financial institution. It was a symbol of stability, power, and ambition. For over a century, J.P. Morgan Chase and its predecessors have been at the heart of American capitalism, a driving force behind railroads, steel mills, and, honestly, the very fabric of Wall Street. The bank's fingerprints are on some of the most transformative projects in American history, from the expansion of the railroads that connected the continent to the rise of the steel industry that built its cities. Its influence has touched every corner of the economy, fueling growth and innovation. J.P. Morgan Chase's story isn't just about money, it's a story about ambition, power, and the men who wielded it. It's about the visionaries who saw opportunity where others saw risk, and the strategists who navigated the storms of economic upheaval. The bank's legacy is built on bold moves, daring rescues, and the relentless pursuit of influence. It's a story of America itself, with all its triumphs and failures, its booms and busts. The rise of J.P. Morgan Chase mirrors the rise of the nation, through periods of explosive growth, devastating depressions, and the constant push for progress. The bank has been there through wars, recessions, and recoveries, adapting to each new era and helping to shape the country's destiny. From financing the Industrial Revolution to navigating the perils of modern finance, J.P. Morgan Chase has left an indelible mark on the world we live in today. Its reach extends far beyond Wall Street, influencing global markets, technological innovation, and the way we think about money itself. The bank's story is woven into the fabric of modern life, touching everything from the buildings we work in to the technology we use every day. But with great power comes great responsibility, and J.P. Morgan Chase's legacy is not without its shadows. The same influence that built empires has also drawn criticism and controversy, as the bank has faced questions about its role in financial crises, ethical dilemmas, and the concentration of power in too few hands. From accusations of unchecked power to its role in financial crises, the bank has often found itself in the crosshairs of public scrutiny. Congressional hearings, investigations, and public protests have all been part of its story, as society grapples with the consequences of concentrated financial might. The debate over the bank's influence continues to this day, raising important questions about accountability and the future of finance. How has this institution maintained its dominance for so long, and what does its future hold in an ever-changing financial landscape? As technology transforms the way we bank and invest, and as new challenges emerge on the global stage, the story of J.P. Morgan Chase is far from over. Its next chapter will be written in the choices it makes and the impact those choices have on all of us. John Pierpont Morgan, the man who gave the bank its name, was, well, a force of nature. Born into wealth, he possessed a keen intellect and an even sharper ambition. He entered the world of banking with a vision to bring order and stability to the often chaotic world of American finance. Morgan believed in the power of industry, and he saw the railroad as the key to unlocking America's potential. He financed the expansion of rail lines across the nation, merging rival companies and creating industrial giants. Morgan's influence extended beyond railroads. He played a pivotal role in the formation of U.S. Steel, the world's first billion-dollar corporation, consolidating a fragmented industry and laying the foundation for America's industrial might. Morgan understood that a stable financial system was crucial for economic growth. He used his influence and wealth to stabilize markets, earning him the title of the banker's banker. He believed that panic and speculation were the enemies of progress, and honestly, he wasn't afraid to intervene directly to prevent financial disasters. The Panic of 1907 was a defining moment for both J.P. Morgan and the bank he built. A financial crisis gripped Wall Street, threatening to send shockwaves through the entire American economy. Banks were failing, the stock market was in freefall, and panic spread like wildfire. In the midst of the chaos, one man emerged as a beacon of stability: J.P. Morgan. Working tirelessly from his opulent library on 36th Street, Morgan summoned Wall Street's titans, orchestrating a series of bailouts and backroom deals. He used his personal fortune and reputation to shore up confidence, injecting liquidity into the system, and preventing a complete financial meltdown. Morgan's actions during the panic of 1907 cemented his legacy as a financial savior. He had single-handedly averted a national catastrophe, but his actions also highlighted the immense power concentrated in the hands of a few powerful individuals. The crisis led to the creation of the Federal Reserve System in 1913, an institution designed to provide a more stable and regulated financial system, a testament to the lasting impact of Morgan's actions. After J.P. Morgan's death in 1913, the bank he built continued to evolve. The House of Morgan, as it was known, remained a powerful force on Wall Street, financing major corporations and shaping the American economy. But the financial landscape was changing. New regulations, born out of the lessons of the 1907 panic, reshaped the banking industry. The Glass-Steagall Act of 1933 forced the separation of commercial and investment banking, leading to the creation of J.P. Morgan and Company for commercial banking, and Morgan Stanley for investment banking. This really marked a turning point, as the bank adapted to a new era of financial regulation. Despite these changes, the Morgan legacy of financial prudence and innovation continued to guide the institution. It expanded its reach beyond traditional banking, venturing into new areas like investment management and securities trading, laying the groundwork for the modern financial conglomerate J.P. Morgan Chase would become. The latter half of the 20th century marked a transformative era for the American banking industry, defined by a wave of intense consolidation and unprecedented change. At the heart of this financial revolution stood J.P. Morgan Chase, a company that would come to symbolize the power and complexity of modern banking. As the landscape shifted with regulations evolving and competition intensifying, only the most adaptive and ambitious institutions could hope to thrive. J.P. Morgan Chase was not just a participant in this era, it was a driving force, shaping the very future of global finance. Guided by visionary and often bold CEOs, the bank embarked on a relentless campaign of strategic mergers and acquisitions. Each deal was carefully calculated, designed to expand the bank's reach, diversify its offerings, and strengthen its competitive edge. These leaders understood that in order to survive and ultimately dominate the rapidly changing financial world, they needed to build an institution with both scale and versatility. The result was a series of transformative moves that would forever alter the banking landscape. The story began in 1955, when Chase National Bank merged with the Bank of the Manhattan Company. This union created Chase Manhattan Bank, instantly establishing it as a major force in the booming New York City market. The merger brought together centuries of banking tradition and innovation, setting the stage for even greater ambitions. Over the following decades, the pace of consolidation only accelerated. In 1996, Chemical Bank and Manufacturers Hanover, two of the largest and most respected banks in the country, joined forces. This powerful combination then merged with Chase Manhattan in 2000, creating a financial powerhouse with vast resources and influence. Each merger brought new talent, technology, and customers into the fold, further strengthening the bank's position. But the defining moment in this legacy of consolidation came in the year 2000, when J.P. Morgan & Co., a storied institution with roots stretching back to the 19th century, merged with Chase Manhattan Corporation. This historic deal was more than just a business transaction. It was the fusion of two financial titans, each with its own legacy of innovation, leadership, and global reach. The result was the birth of J.P. Morgan Chase & Company, a new entity that instantly became one of the largest and most influential financial institutions in the world. With its headquarters towering over the New York City skyline, the bank now had the scale, expertise, and resources to compete on a truly global stage. Through these carefully orchestrated mergers, J.P. Morgan Chase assembled an unparalleled network of branches, a vast and diverse customer base, and a deep well of financial expertise. Its reach extended into nearly every corner of the United States and far beyond, touching the lives of millions. Today, J.P. Morgan Chase stands as a true financial supermarket, offering everything from basic checking accounts to sophisticated investment products and global banking solutions. Its legacy of mergers and acquisitions not only shaped its own destiny, but also helped define the very nature of modern finance, solidifying its position as a titan in the ever-evolving world of banking. J.P. Morgan Chase's rise to dominance has not been without its critics. The bank's immense size and influence have made it a target for those who believe that too much power is concentrated in the hands of a few financial institutions. Concerns about too big to fail banks, institutions so large that their collapse would threaten the entire financial system, have dogged JP Morgan Chase and its peers. The bank's role in various financial scandals, from the Enron collapse to the London whale trading debacle, has fueled public distrust and calls for greater regulation. JP Morgan Chase has also faced criticism for its lending practices, particularly in the areas of mortgage lending and subprime mortgages, which played a role in the 2008 financial crisis. These controversies highlight the complex relationship between financial institutions and the public good. While JP Morgan Chase has undoubtedly contributed to economic growth and innovation, its actions have also at times raised serious ethical and social responsibility questions. The 2008 financial crisis was a defining moment for the global financial system, and JP Morgan Chase was not immune to its effects. As the world watched, the very foundations of banking and finance were shaken, exposing vulnerabilities that had been building for years beneath the surface. The collapse of the housing bubble and the subsequent credit crunch sent shockwaves through the financial world, threatening to bring down even the mightiest institutions. Families lost their homes, unemployment soared, and the stock market plummeted, erasing trillions of dollars in wealth almost overnight. The sense of uncertainty and fear was palpable as ordinary people and seasoned investors alike wondered if the system would survive. JP Morgan Chase found itself at the epicenter of the storm, forced to navigate a treacherous landscape of collapsing asset values, liquidity shortages, and a loss of confidence in the financial system. Inside its offices, employees worked around the clock, analyzing risk, shoring up balance sheets, and preparing for the unknown. The pressure was immense, with every decision carrying enormous consequences for the bank and the broader economy. Despite facing its own challenges, JP Morgan Chase played a critical role in stabilizing the financial system during this turbulent period. Under the leadership of CEO Jamie Dimon, the bank took decisive action, working closely with regulators and government officials to help prevent a total collapse. Its ability to remain relatively stable became a source of reassurance for both Wall Street and Main Street. It acquired Bear Stearns and Washington Mutual, two failing institutions, at the behest of the government, preventing a wider panic. These high-stakes deals were fraught with risk, but they also demonstrated JP Morgan Chase's willingness to step up when others could not. The acquisitions helped contain the crisis, but also brought new challenges and scrutiny to the bank. The bank also participated in government-led stress tests and capital injections, measures designed to restore confidence in the banking sector. These interventions were unprecedented, marking a new era of cooperation between the private sector and government to safeguard the economy. For JP Morgan Chase, passing the stress tests was a testament to its relative strength, but it also meant adapting to a rapidly changing regulatory environment. While JP Morgan Chase emerged from the crisis relatively unscathed compared to some of its peers, it still faced significant losses and legal challenges. Lawsuits and investigations followed, as regulators and the public demanded accountability for the excesses that led to the meltdown. The bank's reputation was tested, and it was forced to confront the consequences of decisions made in the years leading up to the crisis. The crisis highlighted the interconnectedness of the global financial system and the systemic risks posed by institutions deemed too big to fail. What happened in the United States quickly rippled across continents, affecting economies and markets worldwide. The events of 2008 made it clear that no bank, no matter how large or well-managed, was truly isolated from global shocks. It also underscored the need for greater regulation and oversight of the financial industry. In the aftermath, sweeping reforms were introduced to prevent a repeat of the crisis, reshaping the landscape for banks like JP Morgan Chase. The lessons learned during this period continue to influence financial policy and risk management to this day, reminding us of the importance of vigilance, transparency, and resilience in